This presentation is provided by BoardPack LLC for educational and informational purposes only and does not constitute legal advice. The opinions expressed by the presenters are their own and not necessarily those of BoardPack. On behalf of BoardPack, we welcome you to today's webinar. BoardPack has teamed up with Amazon's #1 best-selling author in board governance, Thomas Bakewell, and fundraising guru Carol Weisman to help educate boards on the latest industry trends. The Boardroom webinar series will focus on different topics each month through the end of 2015. I wanted to mention really quickly that BoardPack is a secure, affordable, and easy-to-use paperless board meeting solution. Users can access materials from the native iPad app or through a web browser on other devices. Private annotations, minutes builder, and unlimited document storage are a few highlights of what we have to offer. Before we jump into today's topic, let me tell you a little bit about today's speakers. Carol Weisman, president of Board Builders, is an internationally known speaker, author, trainer, and consultant. Carol specializes in volunteerism, fundraising, and governance. Carol won a Telly Award for her PBS special, Building a Board with a Passion for Mission. Her board experience is vast, having served on 38 boards and served as president of 7.
This is Carol Weisman for BoardPack, and instead of Tom today, I get to work with another dear friend of mine and colleague, Michael Daigneault. And Michael is, as you can see, a self-professed governance geek, and his idea of a good time is reading a new book on governance. And he has a wonderful firm called Quantum Governance, and you can read a little bit about it on the screen. But really what we're here to talk about are the 5 things every credit union board member should know, and this is one of the areas that Michael is a superstar in. So let's get going. Michael, why don't we get going with what are the 5 things?
Well, thanks, Carol. I appreciate the opportunity to speak with you and everyone that's listening in on this webinar. There are 5 things that I think every credit union board member should know, and we'll review each one of these in slightly more detail as we go through, but just to foreshadow the 5. One is that there, as many people know, the consolidation that has been taking place in the credit union industry historically since the 1970s or so, where there were 25,000 credit unions and now there are little more than 6,000, is going to continue. It might even accelerate. And that, too, credit union board members should not be a lifetime job. We'll talk a little bit about that, about how the tenure of credit union board members is extremely long, perhaps longer than it should be. 3, that the composition of credit union boards really needs to evolve or change if credit unions want to remain relevant and competitive. This particular point comes from some research that we've done this past year. It even surprised me as to how strongly people felt about this particular issue. 4, that there is really a big difference. This difference is as big sometimes as the Grand Canyon, a big difference between the fiduciary thought, which many people by default bring to the board table in credit unions, and strategic thought, which I think a lot of credit unions really need. And 5, that good credit union financial performance does not always indicate that the board is doing a great job. Often what happens is boards will conflate the really good returns in the credit union world with their credit union in particular, with the fact that they're doing a great job as a board. Sometimes, of course, that's the case. Sometimes it's not the case. So, Carol, I'm happy to launch into each one of these 5 in slightly more detail. And so let's go to the consolidation one. I think in particular the notion of consolidation is an important feature of what's happening in the credit union field in general.
What do you, Michael, what do you think? This is a staggering number of 25,000 down to 6,000. What do you think causes all this?
Well, there's a number of things taking place. One, in the world today, as many people know, technology and the pace of change have greatly increased. And I think the capital investments that are necessary to be made by financial institutions, by credit unions, is now substantially more than it used to be in the past in order to just keep pace. People are demanding with their smartphones, with their iPads, with all different types of computer systems and the like. They're demanding a certain level of service from credit unions that can only be given if they have substantial capital investments and outlays in technology. Some of the small credit unions can't do this. And so one of the things that's taking place is consolidation as a result of technology. I think consolidation is also taking place simply because of competition. The pace of competition is very rapid, fueled by, yes, technology, but fueled by other factors as well. And as a result of that competition, many of the smaller credit unions have not been able to keep pace. And as a result of them not being able to keep pace, they've either gone out of existence, or really what's happened to the vast majority of them is that they've been acquired or merged into other institutions.
Well, we certainly see the same thing in the medical field where there are consolidation of hospitals. So it seems to be a trend in a lot of industries.
It is. I mean, it's a trend in the banking industry as well. It's not unique just to credit unions. It's happening with banks. Interestingly enough, the number of members of credit unions continues to increase, all the while that the number of credit unions themselves is decreasing. Now, one of the big factors that's happening here is that there's a lot more billion-dollar or above credit unions that exist in this world, and they require a certain level of management and indeed a certain level of expertise at the board level, which indeed will connect us really to some of the other issues that you're going to see on our list of 5 here, that these bigger, larger, more sophisticated institutions are going to be more demanding on their boards, more demanding on the kind of strategic and fiduciary and generative oversight that's necessary at the board level. This is putting real strains on the smaller credit unions as well, and so they just haven't been able to be as competitive and as strategic as they needed to be in order to flourish. Again, fueling this process of people essentially realizing that they need to be merged or acquired by some of the more competitive credit unions. So this consolidation, I think, will continue because of the pace of technology. As I said, I actually would suggest, even though it's been a steady decline, about a 2% decline each year for the credit union industry for some time, and we're talking about upwards of now 250 credit unions a year going out of existence. There could be for the immediate future here an acceleration of that.
And yet you don't see them
by uncertainty.
You don't see them on the endangered species list. What you're also saying is that the ones that exist have a lot of money.
The ones there at least is an increasing number of credit unions that have gotten much larger. So what they're doing in this notion, the consolidation, is not taking place that the credit unions are being absorbed by other types of financial institutions. Occasionally there's a credit union that will transition to become a bank and the like. But the vast majority of the consolidation that's taking place is that the larger credit unions are simply taking over the smaller credit unions.
Should we go on and talk about the board members? Because I think that a lot of board members think they joined the Supreme Court. And it's certainly not unusual to see board members that have been on a credit union board for 20, 30, 40 years, and they're very proud of it. What's the problem with that, Michael?
Well, it's a common phenomenon. And I would say in particular in the credit union community, board service often lasts, as you suggest, for a considerable period of time. Now, there are some reasons for this. One reason is there is a learning curve because it is a financial institution. Indeed, remember, credit unions are cooperative, as many people know, and the people that serve on their boards are elected folks from their membership. And this is a powerful way of them leading and guiding their institutions by having their own members who participate in the actual ownership of the organization and the like. The difficulty here is that once folks become members of credit union boards, it is a badge of honor, and it is something that's very attractive to them.
Are they paid, Michael?
Mm-hmm. What was that, Carol?
I said, are they paid? Is this a situation where essentially a nonprofit board member is paid?
They're not paid, no, although there are now 14 states in the United States where there are two types of credit unions. There are federal credit unions, and then there are state credit unions. The federal credit unions only allow the payments to one person on the board of directors. And that usually is either to the chair or to the treasurer. States have gone a slightly different direction. Of the 50 states right now, 14 of them have allowed payments to credit union board members. And I'm not talking about reimbursements here. I'm talking about actual payment for services.
Mm-hmm.
Usually those payments are rather minor. But for some, there actually are now credit unions in the United States which pay a considerable fee for service on their credit union board. One of the things that studies have indicated is this, of course, could encourage people to stay on their boards even longer. And for folks that are, let's say, retirees, imagine the kind of the social badge of honor that I serve on a credit union board, and let's just say hypothetically it's a $250 million asset size credit union board. You know, it's like I'm a board member of XYZ credit union, and it's a $250 million institution. That's not something that one wants to easily give up. They also get some great educational opportunities. They get to travel to retreats and to conferences and the like. They also, I think, the real critical factor is they get to know each other as a board.
Sure.
The board members, typically 7, 9, 11 people, get to know each other so well. They don't want to lose that social fabric that they've gained with their colleagues. And so this is a very important factor in their lives. Again, with some of them, at least a critical mass, being retirees, and they don't want to let go. The downside, Carol, is that sometimes people hold on a little too long.
Sure.
And what we've got is financial institutions that are being run by folks who have given, and as volunteers and as board members, have really given very, very generously to the institution. But they still may be mired in a thought pattern that could be a decade or more outdated. And so the danger is that people that end up serving too long, and again, that's not everyone, but some people who end up serving too long end up making the institution very conservative or maintaining the status quo. This makes them much less strategically competitive as an institution, and that can be certainly very problematic.
I worked with one board of a credit union, and I thought in many ways it was the worst board I ever worked with. And they were very proud of the fact that none of them had ever missed a meeting, and that they had been meeting for 20 years, and that they all liked the same lunch. And so for lunch, they liked tomato soup and toasted cheese sandwiches. And I said, who is in your audience? I mean, who are you serving? Oh, well, about 30% Hispanic, and on and on and on. And they had nobody that was representative of their members on the board. And it didn't seem to bother them. It was very disturbing.
Well, as the next item indicates, Carol, I think one of the other issues that's deeply connected to this, and that is who is on your board, should really evolve. And of course, to the extent that boards are, let's call it stuck, or preserving the status quo by their very membership and not evolving as a group, this is problematic on a number of different levels. So one of the studies that Quantum Governance has done throughout the country is a study asking people about the credit union board of the future. What might the credit union board of the future look like 5, 7, 10 or so years from now? And what a lot of people said, and this is the thing that really surprised me and I think surprised my colleagues, was that they thought that the membership, the composition of the credit union board should evolve. Now, typically, as I mentioned earlier, the actual membership of credit union boards is made up of members that are elected from the credit union itself. That is to say, they're members of the credit union. They run for a position on the board and are elected to a position on the board. Depending on who the credit union membership is, it can be very vast and very large, and it can have people from all different walks of life and with all different types of skill sets. This can be a great way of constituting your board. By the same token, sometimes it can be a limited field of membership, folks that are all from one particular company or from one particular skill set. And this can hamper greatly the ability to put together a board which has all of the various different facets, like a diamond, that you would want in order to make the board really excel. And so increasingly what people are suggesting is that credit union boards, to the extent that they're able to, and there are some restrictions on whether or not they can bring in people from different segments of the community, from the community at large, and the like, but credit union boards need to do a much better job, it appears, at bringing people into the organization that can really enhance the ability of the board to think strategically, to have financial acumen, to have business savvy, to have marketing and technology savvy, and the like. And again, if the theory has always been, if you had enthusiastic amateurs who were the conscience of the membership on the board, all would be well. But now when you have 500 million, 700 million, indeed billion-dollar or above asset institutions that are credit unions, having merely enthusiastic amateurs is often not enough. You need to bring in adequate expertise, sometimes from even outside the traditional membership boundaries of your institution. And so what the big surprise is that hybrid boards are beginning to now become more and more common, where people will encourage people to run from outside the typical pool of their membership. They're made members of the credit union so they can be eligible to serve on the board. But I've seen one credit union board recently where the board went from 9 fairly typical folks from their rank and file membership to 4 CEOs of major corporations in the community serving on the credit union board. And as you can bet, this really stirred things up rather considerably and changed the conversation and elevated, I think, the conversation in some cases to a much more strategic level.
Michael, why would I want to serve on a credit union board? It sounds like you need a really diverse and very specific skill set. What would be, 2 questions, what would be the skill sets, and why would I want to serve if I don't have those? Because I may be a rank and file member of a union, or I may be a grade school teacher. What are your thoughts about that?
Well, I think there are a number of skill sets. Again, many credit union boards were originally designed, and many still exist, so that anyone, even without very, very specialized financial skills, can serve and serve ably on the board. Indeed, one of the best credit union board members that I've ever seen is a gentleman who's an apple farmer from the local community. But he has the full set of, let's say, business skills, asks good questions. He has a sense for the kind of the cyclical nature of an organization and the types of questions that need to be asked, and audits that need to be done, and marketing that needs to be accomplished, and making sure that you're paying attention to the employees and to the CEO of the organization. So it's not that every single person on a credit union board needs to have specialized skills. I think the attraction to some folks, again, as I mentioned earlier, is that it's a badge of honor, it's prestigious. For some people, it's an opportunity to give back. They're really impassioned by the opportunity, particularly the baby boomer generation folks love to give back, and I think this fuels their desire to serve on the credit union board and make sure that their own monies, but the monies of their colleagues and the monies of the other folks from their legacy organization are well protected. They're safe and sound, as they would say in the credit union field, but that indeed the credit union flourishes. And so I think it's an opportunity along those lines that a lot of people want to take advantage of. Now, not everyone. And so what would be the attraction of someone who's not a member of the credit union? There are a number of different ways that it can actually work. One of them is professional development. Serving on a credit union board is a terrific way
I would think so.
an up-and-coming CPA, an up-and-coming lawyer, an up-and-coming marketing person, an architect, a business person, to really learn a number of financial and strategic and marketing-type skills that could be immensely valuable in their own personal lives. So I do think it's a great opportunity along those lines. And again, if positioned and framed carefully, very, very sophisticated people joining with legacy members make a great combo, a 1-2 punch, in encouraging that credit union board and that credit union in general to rise to a more sophisticated level.
How do you get people who are young being defined differently by everybody, but certainly younger? I remember you telling me one time the average is 61 years of age, so young may be 35 or 40, not 23 and maybe 23. But how do you get them to run?
Well, let's call the young folks that I think a lot of boards today, nonprofit boards, credit union boards, indeed even the many corporate boards today, they want millennials, people born after 1981, to serve on their board, and it is a big challenge right now because the Generation X, the generation just before millennials, is a rather small generation. There's only about 45 million or so Gen X folks in the world, and so there's a big gap. After baby boomers, a generation that's in the 80 million range, and unfortunately decreasing in size because baby boomers are aging and will be aging off boards soon. Gen X, 45 million or so, is a smaller generation, and we need to get more and more Gen Xers to serve on boards. They're just as socially acute, younger than baby boomers, of course, but they serve in different ways. They're the first generation really to be fully immersed in technology and the like, and so some of them will say, well, I think board meetings are kind of a waste of time, but if you want me to do something, send it to me on my iPhone or my Samsung, and I'll get it done. Millennials often are now in the throes of raising young families, and so it can be very difficult to recruit them, and yet they can be some of the most valuable people on a board because technology for many millennials is not an interesting tool or the like. It's in some ways the air that they breathe. They are immensely familiar with technology, and in light of the intense technology pressures on many institutions to update their technology and stay current, their voice, their awareness of how technology works in today's day and age can be quite valuable on the board. And so I think what you've got to do is be smart. You can't have every one of your board meetings in the middle of the day at lunch because millennials are on the job. They're working.
Well, I think millennials like to eat, and so I think if you offer the right kind of food at the right time, you could probably get them. Why don't we go on to taking a look at the strategic planning elements? Because
Sure.
This is a major issue in credit unions. Obviously, it's similar to most organizations, vision, mission, values. And how are the planning elements for a credit union any different than any other nonprofit or for-profit?
Well, I would say actually they're not surprisingly different from, at least in my mind, what many nonprofits also need to do. The challenge is that the legacy of many credit unions, the focus of their thought has been on fiduciary oversight. it has been on protecting the safety and soundness of the institution. And so they've been somewhat habituated into thinking in a particular way, and that is in a kind of fiduciary oversight manner, protecting the institution. And so the challenge is that the board members in today's day and age need to increasingly also be aware of their strategic role in constructively partnering with management to help craft the strategy.
Do you think the board members are too risk averse? Is that what we're seeing in these 61-year-old white guys?
The risk tolerance of many credit union board members is very, very low. So when you put together the picture of it's the status quo, it's very, very low level of risk. It's a reticence to take strategic leaps into certain technological areas and the like. When you put those things together, what happens is that the strategy gets swallowed by a particular set of cultural characteristics, which are very, very business conservative in nature, that they don't want to take risks. Now, not taking risks, of course, at times can be very prudent, but in today's day and age, if you're too risk adverse, you're probably not taking the strategic steps that you need to take in order to really flourish, in order to really, really be successful. And so there just literally has to be a balance. There has to be a clarity around the vision and the mission and the values of the institution. And I think the board should be instrumental, as I show on this screen right here, in working with senior management at the blue level. This is where the board gets involved in helping to set the strategic goals, objectives, and metrics of the institution. Not simply relying on management, but constructively partnering with management in order to set those ideas in the blue boxes. And then at the orange level here, this is where management is responsible. Hopefully it's aligned with and responsive to what's been said at the blue level, in which board and management work together. But I think this is where, frankly, boards in the credit union field need to dive in much more deeply, and that is figuring out how we can be more deeply involved and immersed with management at the strategic level. This also, of course, Carol, harks back to what we talked about before, and that is therefore you have to have a good mix of people on your board that are capable not only of fiduciary oversight, but also of sustained strategic thought. And indeed, you'll see on the next slide, there are a number of strategic markers that will help board members think about and decide whether or not they're in the middle of a strategic conversation or not. You know, is this a big issue? Is this something that has a big material impact on the institution? Is it about the future of the institution? Strategic questions often are not about what happened in the past, but where should we go? Is there a problem? You know, is there some type?
Is that what the red flag is? Tell me about the red flag concept.
In some ways, is there a red flag? Is there a problem, or is there a regulator that has flagged something that they need to improve? The credit union field is a regulated industry, and so they get regularly examined. Sometimes the regulators will red flag something. Sometimes even just the returns, the performance of the institution will red flag something. It could be an economic indicator or the like. And so these can be indicators that a strategic question has arisen. Sometimes it's the CEO asking for help, saying we have a really serious, concern or issue that we need to address. Another strategic marker, something that would indicate that it's
Can we go back to the CEO business for 1 second?
Oh, sure.
My question there is, what happens if the CEO doesn't ask for help and there is a red flag and he or she gets the red flag from an auditor or a regulator and doesn't share it with the board? So as a board member, what should I know about this business of what's the CEO's responsibility and what I'm liable for, and how do I know if there's a red flag and the CEO hasn't asked for help?
Well, this is a great question, Carol, and it's at the front lines of many of the boundary questions and issues that flow from the relationship between boards and the CEO or senior management members. This is why board members in a credit union do see the audit. Particularly, the credit unions have what they call a supervisory committee, which is the equivalent in the nonprofit field of an audit committee with some special powers that it has. And they are deeply involved in looking at the audit and the finances of the institution. And so, being a nonprofit, they're also required as an institution to submit their financial information to the regulator. And so there is a reasonable amount of transparency. But I think your question is still an important one, and that is what if the CEO doesn't flag it? What if the CEO doesn't say, I need help here? The board members actually have to be courageous enough and, frankly, competent enough to be aware that it is an issue and it's something that they need to be asking about themselves. And so where problems have sometimes occurred in institutions is that the CEO doesn't ask for help or doesn't flag it. And sometimes this can lead the credit union astray. Each board member on the credit union board needs to be, to a great extent, a kind of an independent thinker and asking the hard questions about what's going on in the credit union. And sometimes those hard questions are, yes, oversight or fiduciary questions, but sometimes they're the big strategic questions, which can have the biggest impact of all.
Well, you say is a watchdog watching. Tell me an example of who would be a watchdog and what would they be watching?
Well, a typical watchdog in this case would be one of, let's say, two or three different types of institutions. One would be a federal or state regulator, as I mentioned before. Sometimes, by the way, the institution could have its own watchdogs inside it, and that is to say, the supervisory committee, the audit committee, very unique in the credit union field, some of the powers that they have, in that they have the power different than in the nonprofit field, even different than in the for-profit field. The supervisory committee of a credit union has the opportunity to suspend the board members or officers of the board of the institution. They are literally a watchdog within the institution. There are now also other institutions that have been set up on the federal level that are protection agencies for the consumers of financial, for various different types of financial products and services, and there are now independent watchdogs. And so from any of these sources, the regulators, the federal watchdogs themselves, the agencies, or in addition to that, even internal to the organization, and sometimes even the membership itself of a credit union that can be critical of what's going on. From all of these sources, one of the things one has to look at is beyond just sometimes the details or the facts of the situation to, does this have a kind of a strategic impact, or are there some strategic questions here that are really being raised? And so again, it's a marker. It doesn't guarantee that it's a strategic question, but at least it's something that could be a potential indicator.
Tell me about this high-level policy. Can you give an example of what's a high-level policy versus a low-level policy or a mid-level policy?
Well, yeah, I'm speaking obviously somewhat colloquially here. What I'm talking about is a policy that would have implications for the entire institution. So the type of high-level policy decision that I would suggest here, a good example would be where someone at a board meeting raised his hand at a credit union board meeting and said, you know, folks, we're too risk adverse. We're not taking enough risk. And the credit unions have been traditionally evaluated in what's something called a CAMEL rating, and this is a rating by the regulators as to how financially fit and the like the institution is regarded. A CAMEL 1 rating is the best possible rating that you could get. A CAMEL 2 rating is very good, but certainly below that. And what he did was he said, I think we should become a CAMEL 2 institution, Well, this was shocking to his colleagues. I mean, why would you go from level one, which is the best, to level two, which is in many people's minds second best? And he says, well, because we're not fulfilling our fundamental duty as a credit union, that is to serve the underserved in our community. He literally was saying we're not taking enough risk.
Yep.
We should have a policy that says we take more risk. We should serve more of the underserved in our community, even if it has a kind of a negative impact on our finances. This is the right way for us to go.
Do you think this is
at that high level? That's what I mean by high level. He's talking about the overall policy and direction of the institution.
Do you think this has been affected by the micro-lending movement worldwide?
Well, it's interesting. Micro-lending has been remarkably successful in a number of countries. There's some controversy about it in some places, but I think it's shown that it could have a major impact. Credit unions are impacted by this because micro-lending has caught on, frankly, not only overseas, but also now here in the United
Sure.
States. And credit unions need to regard the micro-lending movement as a potential competitive force in which they need to adjust and evaluate their own performance. There are ways, for example, for credit unions to be involved in various different types of micro-lending types of opportunities. And indeed, in light of the very spirit of a credit union, which is to offer credit to people that might not otherwise be
Sure.
able to get it, I encourage my credit union clients to be involved in various different types of micro-lending types of paradigms that could benefit their membership in both small and perhaps ultimately large ways.
So, the final issue of your number five, this seems unfair. If the credit union's doing well and I'm on the board, why can't I take the credit? Give me a break here, Michael.
I know, and I
This seems
can appreciate
unfair.
your perspective on this, Carol.
If my
It
kids
does seem-
do well, I take credit. If they do poorly, I blame my husband. It seems fair to me. I really don't see, I really think if they do well, it's as a board member, it's because of me. If they do badly, it's because of staff. Come on.
I think it's only natural for many people to feel that way, which is why I put this one in this particular list, because it does seem a little bit, let's call it counterintuitive. But our experience is that often the two, of course, do align. And I don't want to in any way suggest that often, because credit unions are doing well, many times their boards are doing a great job, and they are participating, as I mentioned before, in a kind of a constructive partnership with management. As a result of that constructive partnership with management, the credit union is flourishing and doing well. But there are also circumstances, and this is a big but, in which sometimes the credit union is flourishing despite the board. That is to say, the credit union is doing well financially, the numbers are up, but sometimes the numbers are up because of the economy. Sometimes the numbers are up because of something that's taking place in the economy or in the legacy institution in which the credit union deeply participates. And what we find is that sometimes the board is really in the posture of not pushing forward the success of the credit union and being able to legitimately claim, let's say, co-credit along with management. Sometimes what's happening is that management is having to encourage the success of the credit union and its members despite the board, because the board might be stuck again in a kind of older or more conservative pattern, and therefore the board is really not a full constructive partner with management, and they're not really able to take credit, at least in our minds, when we dig down deeper in the success of the institution. And so, this is where we have to be careful. We don't want to be too harshly critical of credit unions because many of them are doing a great job. And yet there are circumstances, and this unfortunately happens probably a little more often than people would intuitively suspect, where the credit union is flourishing or doing well. The numbers are up, but why the numbers are up is not always that clear. And so I would want to suggest to you and to everyone listening that sometimes the reason the institution, that could be a credit union, could be a nonprofit, It could even be a corporation is flourishing despite the board. And so boards really need to make sure that they're not holding the institution back, that they are truly an innovative, creative, effective partner with management. Yes, holding management accountable. Yes, providing adequate oversight, but also at the strategic level, as we foreshadowed before, at the strategic level, really being the kind of partners that management would go to, where management would go to members of the board as a whole, and say, we seek your advice. We value and want your advice. One of the most heartbreaking instances that I've run into in a number of credit unions and some nonprofits is the fact that sometimes I'll ask the CEO of the institution, hey, who would you go to for advice on your board? And sometimes the answer is no one. And so we just need to make sure that the board members are not deceiving themselves in thinking that because there is good performance in the credit union overall, it's because of somehow the efforts of the board itself. Sometimes it is, and sometimes it isn't. And we just have to be able to distinguish the two. That's why we do assessments. We do all kinds of interviews and retreats and all of that with boards in order to help educate them and help them understand what their contribution to the institution either is or perhaps sometimes isn't.
Well, I will accept this with credit unions, but I will continue to take credit for my children's good behavior. So let's bring it home, Michael, with the summary.
Well, bottom line, Carol, I think we've discussed 5 things, and that is one, as many people certainly in the credit union industry know, but sometimes people in the nonprofit field might not know quite as much, and that is there is a major consolidation taking place in credit unions, again, down from 25,000 in the 70s to 6,000 now, probably to the 4,000 or so level in 2032, and could go below that. There are some people that are predicting there'll be as few as 1,000 credit unions in the United States in the coming decades. And this is a major shift. It's a difference in degrees so significant, it's a difference in kind. This then has implications of who should be on the boards and how long they should be on the boards. And so we mentioned in points number 2 and points number 3 that board membership should not be a lifetime job. There really needs to be an effort to recruit new types of folks onto credit union boards. Again, a more diverse group and traditional diversity, but also diversity of thought, and that there needs to therefore be room for people to be brought onto these boards so that they're not stuck. The composition of the board itself, indeed, even needs to evolve beyond the traditional membership that is brought onto credit union boards, but might need to reach out and find people that have particular skills or attributes that they can add to the mix, be they technology or business orientation, financial skills, and the like. This will help credit unions remain relevant and competitive for decades to come. It doesn't mean that everyone on the board should be recruited in that way. Again, this is why I would call it a hybrid kind of concept or paradigm, and that is there's a balance between legacy members and members that have been brought on for particular things that they can bring to the institution. We ended on a couple of notions about the actual, in some ways, the deliberations of the board. One of the most important being is there is a big difference between fiduciary oversight and strategic thought. There still needs to be excellent fiduciary oversight, but in addition to that, the strategic thought is really the value add of that can be brought to credit unions, and credit union boards need to be very careful. Board members need to be very careful that they don't just get stuck in providing the fiduciary oversight aspect of their jobs without also celebrating some of the creative, innovative, strategic thinking that needs to take place regularly in board meetings. And then finally, as a reality check, boards need to be aware of the fact that sometimes really good financial performance does not necessarily mean that there's good board performance. Sometimes this will lead to the notion of, it ain't broke, so why fix it? But our assessments and studies will show sometimes that what's really happening is they would have even greater financial performance if the board was more effective at its role. And so sometimes good financial performance does not equate to effective board performance. And so boards themselves, much like CEOs, should be regularly evaluated and should take a really hard look at how they're contributing to the success of the credit union, and ultimately, of course, to the success of the credit union's mission and its members. With that, Carol, as is usual, I don't have any other opinions.
Well, thank you so much, Michael. And you have a wonderful holiday season. And thanks to all of our credit union members who listened. And thanks for all you do. Signing off.
Thank you, Carol, and thanks to BoardPAC for giving me this opportunity to have this discussion with you. Really appreciate the opportunity.
Thanks.
Thank you again to Tom and Carol for your wonderful insight today. If you have any questions or comments for today's speakers, their contact information is on the screen. If you have interest in learning more about BoardPAC, please send us an email, sales@boardpac.com.